Radixers, welcome to our Financial Facts channel. We Radixers will give you some valuable tips and tricks on how you can make yourself financially independent regardless of what you earn now and where you live now. Today we will see one of the most important investment strategy that will benefit you in your investment journey. That is DCA, dollar cost averaging. The dollar cost averaging is an investment strategy. It has been used by many professionals and institutional investors, which is much better than aiming to buy low and sell high. Let me explain what is DCA, how you can utilize this. As many experts will tell you, nobody can time the market. Dollar cost averaging is investing a fixed amount of money in the same fund or stock at regular intervals over a long period of time. For example, assume you deposit $1,000 on the first of each month into Microsoft beginning in January. Like any investment, this fund bounces around in price from month to month. In January 1, Microsoft was at $107 per share. By February 1, it was at $96. By March 1, it was $99. By April 1, it was $106. And by May 1st, it was $112, and now the current price is $126. If you keep steadily putting $1,000 into the fund on the first of each month while the numbers of shares that amount of money buys varies. In January 1, $1,000 bought 9.3 shares. In February 1, it bought 10.5 shares. In March, it bought 10.1 shares. In April, it was 9.4 shares, and in May it was 8.9 shares. Just 5 months after beginning to contribute to the investment, you own 48.2 shares of the Microsoft. The average price of those shares is 106. Based on the current price of these shares, the investment of $5,000 has turned into $6,073.2. If the investment has spent the entire $5,000 at once at any time during this period, the total profit might be higher or lower. But by this strategy, the risk of the investment has been greatly reduced. Dollar cost averaging is a safer strategy to obtain an average price per share that is favorable overall. Thank you for watching.